Hello everyone, my name is Sethi. I hope you all are staying healthy. Today we are going to talk about theories of capital structure. Capital structure is mix of various long-term sources of funds like debts, equity and retained earning. These funds we use in order to grow our business. Or you can say that capital structure is systematic approach to financing business activities by using combination of debts and equity. But main question is that if you change ratio of debts and equity, it will really affect the value of firm or overall cost of capital. Well, theories of capital structure give answer of this question. Theories of capital structure divided into two parts, relevant theory and irrelevant theories. Relevant theories suggest capital structure does affect value of a firm. Net income approach and traditional approach are part of relevant theories. On the other hand, irrelevant theories suggest capital structure has no effect on value of a firm. Net operating income approach and approach are part of irrelevant theories. One by one we discuss about each relevant and irrelevant theory. Net income approach. Capital structure is combination of debts and equity. According to this approach, if in your capital structure you increase debts as compared to equity, then value of your firm increase but overall cost fall. That means debts and value have a positive relation. As you increase debts, value of firm will also increase, but debts and overall cost have a negative relation. If you increase debts, then overall cost fall according to this approach. But why, as you are using more debts as compared to equity, then overall cost fall, but value of organization increase? Debts are cheaper source of finance as compared to equity. Obviously, when you are using cheaper source of finance, then overall cost will fall. But why value of company increase when you are using more debts as compared to equity? For example, you are using more debts but you have very less equity. You just have 10 shares. Net profit 1000 rupees. 1000 divided by 10. So EPS is 100 rupees, means earning per share is 100 rupees. Now suppose you are using less debts but more equity. Now you have 50 shares. Now earning per share is 20 rupees. According to this theory, as EPS increase, value of company increase, but when EPS fall, value of company fall. Obviously, to see high EPS, investor want to invest more in company, eventually value of company increase. So here you can clearly see when you use more debts, EPS increase. When EPS increase, value of company also increase. Here you are using less debts, that's why EPS fall. As EPS fall, value of company fall. In short, we can say that according to this theory, if we are using more debts as compared to equity, then overall cost fall, but value of company increase. Now we will see net operating income approach. This is part of irrelevant theory and opposite to net income approach. According to this approach, capital structure don't affect value of a firm because value of firm mainly influenced by operating income and business risk. We represent value of firm and we can calculate value of firm when we divide earning before interest and tax with overall cost of capital. According to net income approach, debts are cheaper source of finance because in debts we pay interest rate. Through this interest rate, we can save some taxes. If in order to calculate value of firm, we are taking earning before interest and taxes, means we are not taking influence of interest rate and taxes, then there is no point to say debts are cheaper source of finance as compared to equity. In short, according to this theory, market value of firm don't depend on capital structure because market value of firm mainly influenced by operating income and business risk. Second reason, if you are taking so much debts in order to run your business, then your shareholder might get afraid. They will think one day your organization will bankrupt because you are using so much debts. That's why they will demand for high return. You took benefit from cheaper source of finance, which is debts, but your shareholder demanding a higher return. Higher return and cheaper source of finance, benefit from cheaper source of finance will cancel out. Eventually your overall cost of capital remain constant. So it doesn't matter you change your debts equity ratio or not, your overall cost or value of company will remain same, because according to this theory, value of company mainly influenced by operating income and business risk. Capital structure don't influence the overall cost or value of a firm. Now we see traditional approach. This approach consider middle ground, because according to this approach, there is optimum balance of debts and equity where value of company maximum but cost is minimum. That means there is one specific point of perfect balance of debts and equity where you can increase value of firm at maximum level and reduce cost at minimum level. Traditional approach talks about three stages. First is the benefit phase, where a company adding more debts as compared to equity. Obviously debts is cheaper source of raising fund, that's why company is using more debts as compared to equity. If company is using cheaper source of finance, then obviously overall cost will fall. So initially overall cost will fall. Second thing, amount of debts is very less, that's why investor means shareholder are not worry about company will become bankrupt, so they will don't intervene or they will not demand for a high return. So in this stage value of company will also increase. So this will be called beneficial phase, where overall cost fall and value of company will increase. Second is optimum phase. Here we have perfect balance of debts and equity. Every finance manager want to reach at this stage, because here cost is minimum but value of company is maximum. In first stage cost was reducing, but in this stage cost reach at their minimum point. A will be called minimum point of cost. After a point cost start increasing, that's why A will be called minimum cost point. In this stage the organization has reached at this A point. Initial stage, in first stage value of company was increasing, but at B point value of company become maximum, after that start reducing. So B will be called maximum point of company value. In this stage company has achieved minimum cost point and maximum value point of organization. That's why this will be called perfect balance of debts and equity ratio, and every finance manager want to achieve this stage. Danger phrase, at this stage cost start increasing. After a point you can see cost start increasing and value of a company start falling. After B point you can see value of company start falling. But why? Because of high risk. If you are taking so much money through debt, so obviously you have to pay high interest rate, your overall cost increase. Second thing, shareholder get afraid, they demand for high dividend. If they demand for high dividend, obviously cost increase. And in this stage, in short you can say that in this stage cost increase and value of company fall. That's why this stage will be called danger phase. Now we are going to talk about Modi-Gilani-Miller hypothesis, which is part of irrelevant theory. According to this theory, there is no relationship between capital structure and value of company. That means value of company will not influence by their capital structure. For example, it doesn't matter whether you cut pizza into 4 pieces or 8 pieces, amount of pizza will remain same. Similar, it doesn't matter how much debts or equity you use for raising fund, value of your company will remain same. So value of company not influenced by their capital structure. This theory talks about arbitrage process. For example, there are two companies A and B, but their value is different due to different capital structure. Value of A company is more, but value of B company is less. Investors start selling shares of high valued company but start buying shares of low valued company. After a certain time period, through this process, value of both company will become equal to each other. So by this way, value of company decide not by their capital structure. So this theory assume as you increase capital, as you increase debts, then you also increase financial risk. That's why your overall cost of capital remain constant according to this theory. Common assumption across theories. First is perfect capital market. All information available to everyone. That means shareholder knows each and everything about a company, either bad or good. No taxes. There are only two sources of finance: debts and equity. We don't include preference share. 100% dividend payout. That means all earning are distributed among shareholders. Risk of business will remain constant. In real life, sometime risk increase or sometime fall, but in this theory we assume risk remain constant. That means businesses risk remain constant regardless of their financing. This is all about today's video. I think you got it, and thank you so much for watching this video. Bye, take care.